The Illusion of Power. September 15, 2008. The morning air in lower Manhattan felt ordinary. Commuters moved through subway entrances. Coffee carts steamed along the sidewalks. Taxis honked impatiently near Wall Street. But inside the glass tower at 745 7th Avenue, something historic had already happened. After 158 years in business, Lehman Brothers had filed for bankruptcy. It was the largest bankruptcy in American history. Over $600 billion in assets. Gone. For most Americans, the collapse felt sudden, like a building imploding without warning. But financial institutions do not collapse overnight. They erode slowly, quietly, behind closed doors. To understand what really happened to Lehman Brothers, we have to go back. Not months, but decades. Lehman Brothers did not begin as a Wall Street titan. It began in 1850 in Montgomery, Alabama. Three immigrant brothers, Henry, Emmanuel, and Mayer Lehman, opened a small dry goods store. They quickly realized something important. Farmers often paid for goods with cotton instead of cash. The Lehman Brothers began accepting cotton as payment and reselling it. Without intending to, they stepped into the world of commodity trading. When the Civil War disrupted the South, the brothers relocated to New York. There, they entered the New York Cotton Exchange. And from that moment forward, Lehman was no longer just a merchant. It was becoming a financial intermediary. Over the next century, Lehman helped finance the growth of American industry. Railroads, airlines, retail giants. It underwrote securities, managed public offerings, facilitated capital flows. It survived the panic of 1907. It survived the Great Depression. Survived 2 world wars. It survived the oil shocks of the 1970s. By the late 20th century, Lehman Brothers had become one of Wall Street's most respected investment banks. But something changed in the 1980s, and that change reshaped the DNA of Wall Street itself. In earlier eras, investment banking was conservative. Firms advised corporations, underwrote bonds, facilitated mergers. Risk was managed carefully. Reputation was everything. But by the 1980s and 1990s, financial markets were evolving. Deregulation, financial innovation, global capital flows, and most importantly, leverage. Investment banks discovered they could dramatically increase profits by borrowing heavily and trading aggressively. Instead of simply advising clients, they became traders, market makers, speculators. The more leverage they used, the higher their returns in good times. And in good times, no one questions leverage. Lehman embraced this transformation. By the early 2000s, it wasn't just an investment bank. It was a global trading powerhouse. Its revenues increasingly came from complex financial products, mortgage-backed securities, derivatives, structured debt instruments, products that promised high yield in a low-interest rate world. At the center of this new era was a powerful incentive structure. Bonuses. Compensation on Wall Street was tied to annual performance. Not 5-year performance. Not long-term stability. Annual performance. If a trading desk generated massive profits in 2006, bonuses were paid in 2006. If those trades imploded in 2008, that was someone else's problem. This short-term focus quietly shaped decision-making inside Lehman. Risk models assumed housing prices would not fall nationally. Credit ratings agencies assigned high ratings to complex securities. Investors around the world demanded higher yields than government bonds could provide. Lehman met that demand, and it did so aggressively. By 2003, a powerful engine was fueling Wall Street profits: the American housing market. Homeownership had long been considered part of the American dream. After the dot-com crash of 2000, the Federal Reserve lowered interest rates dramatically. Cheap money flooded the economy. Mortgage lending surged. Banks began issuing loans to borrowers with weaker credit histories, known as subprime mortgages. Historically, these loans were considered risky, but financial engineering changed the equation. Banks no longer held mortgages on their books. They pooled them together, sliced them into tranches, packaged them into securities. and sold them to investors. This process was called securitization, and it created a dangerous illusion, because once mortgages were bundled and sold, the original lender no longer bore the risk. Risk was dispersed, or so it seemed. Lehman became one of the largest underwriters of mortgage-backed securities. It didn't just facilitate the market, it invested in it heavily. By 2006, Lehman had amassed enormous exposure to real estate assets. Its leverage ratio climbed above 30 to 1. That meant for every dollar of equity, Lehman borrowed roughly $30. In a rising market, leverage amplifies profits. In a falling market, it amplifies losses. But in 2006, housing prices were still climbing. Confidence was everywhere. Executives believed diversification would protect them. Internal risk models suggested declines would be manageable. Few believed housing could collapse nationwide. Few imagined that defaults could spike across multiple states at once. And even fewer imagined that liquidity, the ability to sell assets quickly, could disappear. That belief in perpetual liquidity would prove fatal. There's something psychologically powerful about long institutional history. When a firm has survived wars and depressions, it develops an aura of invincibility. Lehman executives often referenced the firm's 150-year legacy. They believed they had navigated crises before. They believed they understood risk. But this crisis was different, because this crisis was built inside the system itself. By late 2006, subtle warning signs were emerging. Housing price growth was slowing. Adjustable-rate mortgages were resetting to higher payments. Delinquencies were ticking upward. Some hedge funds began betting against subprime securities. Inside Lehman, not everyone was comfortable. Risk officers questioned exposure levels. Analysts raised concerns about liquidity buffers. But profits remained strong. And on Wall Street, strong profits silenced doubt. The public narrative in early 2007 remained optimistic. Executives reassured investors. Earnings calls emphasized resilience. Balance sheets appeared healthy. But balance sheets can conceal as much as they reveal. And what they concealed at Lehman would later become one of the most controversial accounting maneuvers in modern finance. An internal practice known as Repo 105. But before we get there, we need to understand something fundamental. Financial institutions do not collapse solely because assets lose value. They collapse because confidence disappears. And once confidence evaporates, it spreads, quietly, like a crack running through glass. By mid-2007, the crack had formed. The housing market was no longer stable. Subprime lenders were beginning to fail. And Lehman, despite its 158-year legacy, was standing at the edge of a storm it did not fully comprehend. The illusion of power was still intact. But beneath the surface, the foundation was shifting. And in finance, when foundations shift, the fall can be sudden. Very sudden. The risk machine. By early 2007, the housing market was no longer climbing. It wasn't collapsing yet, but it had stopped rising. And for a system built on perpetual appreciation, that was enough. Inside, traders were watching the numbers carefully. Delinquencies were ticking up. Mortgage originators were struggling. Subprime lenders were filing for bankruptcy. But Lehman wasn't just exposed to mortgages. It was exposed to the machinery that had grown around them. And that machinery was enormous. To understand Lehman's vulnerability, you have to understand how modern investment banks operated in the early 2000s. Unlike traditional banks that hold deposits and issue loans, investment banks relied on short-term borrowing to fund long-term assets. This funding came primarily from what's known as the repo market, short for repurchase agreements. In simple terms, Lehman would borrow money overnight by posting securities as collateral. The next day, it would roll that borrowing over. And the next day, and the next. As long as lenders trusted Lehman's balance sheet, the system worked. But if trust faltered, even briefly, funding could vanish. And if funding vanished, so would Lehman. This is the vulnerability of leverage. And Lehman was highly leveraged. At times, its leverage ratio exceeded 32. That meant even a small decline in asset values could wipe out its equity. Yet internally there was confidence, because the models said risk was manageable. The models said housing would not decline nationwide. The models said diversification would protect them. The models said liquidity would always be available. The models were wrong. By mid-2007, cracks in the mortgage market were widening. Two hedge funds at Bear Stearns collapsed due to subprime exposure. Investors began reevaluating structured products. Complex securities once rated AAA began losing value. Liquidity thinned. But Lehman didn't retreat. In fact, it doubled down. Rather than aggressively selling real estate assets, Lehman increased its exposure. Executives believed competitors were overreacting. They believed panic would subside. They believed they could ride out temporary volatility. And in the short term, that belief seemed justified. Through much of 2007, Lehman remained profitable. Its stock price fluctuated but did not collapse. Publicly, executives projected confidence. Privately, liquidity managed them. Because even if assets were sound in theory, they had to be fundable in practice. This is where Repo 105 enters the story. Repo 105 was a specific type of repurchase agreement used by Lehman. Under normal repo transactions, securities are temporarily exchanged for cash, but remain on the balance sheet as financed assets. Repo 105 was structured differently. Lehman treated certain repo transactions as sales rather than borrowings. This allowed it to temporarily remove billions of dollars in assets from its balance sheet just before reporting periods. By doing so, it reduced reported leverage. Then, after earnings were announced, the transactions reversed. Assets returned. Leverage increased again. From an accounting perspective, this maneuver exploited a technical interpretation. From a perception perspective, it was powerful. Investors saw lower leverage ratios. Analysts saw improving balance sheet strength. Confidence held a little longer. But this was cosmetic surgery. It did not reduce real risk. It only delayed recognition. And internally, executives knew liquidity pressures were mounting. Meanwhile, the broader market was deteriorating. In March 2008, Bear Stearns collapsed. The firm was rescued in a deal orchestrated by and acquired by J.P. Morgan. This was a turning point. For the first time, a major Wall Street institution had failed because of mortgage exposure. And suddenly, investors began asking a new question. Who's next? Lehman's stock dropped sharply. Counterparties became cautious. Credit rating agencies signaled concern. And liquidity, that invisible lifeline, grew fragile. Inside Lehman, executives insisted their situation was different. They argued that their capital base was stronger, that their asset mix was more diversified, that the market was mispricing their risk. But markets do not require certainty to panic. They only require doubt. And doubt was spreading. By summer 2008, Lehman was fighting on multiple fronts. Its stock price had fallen dramatically from its peak. It sought fresh capital from investors. It explored asset sales. It negotiated potential strategic partnerships. But every potential deal faced the same obstacle: transparency. Potential buyers wanted clarity on the true value of Lehman's real estate holdings. And that value was increasingly uncertain. Because the housing downturn was no longer localized. It was national. Foreclosures were rising across states. Mortgage-backed securities were trading at steep discounts. And illiquid assets are dangerous when you rely on short-term funding. Internally, tensions escalated. Risk managers warned about exposure levels. Treasury teams monitored daily liquidity needs. Executives debated strategy. Some believed Lehman should sell assets aggressively, even at losses, to stabilize confidence. Others believed selling would signal weakness and accelerate panic. In hindsight, this debate seems obvious. But in real time, it was deeply complex. Selling billions in assets into a falling market could trigger further price declines. Holding assets risked funding evaporation. There was no easy path. And time was running out. In financial crises, timing is everything. Markets can shift in days, sometimes hours. In early September 2008, Lehman reported a $3.9 billion quarterly loss. It announced plans to spin off state assets. It attempted to project resilience. But investors were no longer reassured. The stock fell further. Credit default swap spreads, a measure of perceived default risk, spiked. Counterparties reduced exposure. Short-term lenders hesitated. The repo market tightened. And when short-term lenders hesitate, an investment bank begins suffocating. Because unlike traditional banks, investment banks do not have deposit insurance. They rely on market confidence. And confidence was evaporating. Behind closed doors, executives began seeking a buyer. Two institutions emerged as potential saviors. Negotiations intensified. But buyers demanded government guarantees. They feared hidden losses. They feared open-ended liabilities. And without federal backing, they hesitated. This placed enormous pressure on policymakers. Earlier in the year, Bear Stearns had been rescued. Now, officials at the Treasury and Federal Reserve faced a decision. Should Lehman be saved? Or should market discipline prevail? The concept of moral hazard loomed large. If the government rescued every failing institution, banks might take even greater risks in the future. But if Lehman failed, what would happen next? Would markets stabilize? Or unravel? These were not theoretical questions. They would be answered within days. By mid-September 2008, Lehman's liquidity position was critical. Short-term lenders were pulling back. Potential buyers demanded guarantees. The window was closing. Inside the firm, employees sensed something was wrong. Rumors circulated. Trading desks felt the strain. Phones rang continuously. Confidence was gone. And once confidence disappears in finance, it rarely returns quickly. Lehman's risk machine, built on leverage, short-term funding, and complex securities, had functioned flawlessly during expansion. But it was never designed for contraction. It assumed liquidity. It assumed confidence. It assumed markets would cooperate. Now, those assumptions were collapsing. And when assumptions collapse, institutions follow. As the weekend of September 13th to 14th approached, Wall Street prepared for emergency meetings. Government officials gathered in New York. Executives from major banks convened. Lehman's fate would soon be decided. But by then, the risk machine was already broken. And what happened next would reshape the global financial system. The question was no longer whether Lehman was in danger. The question was whether anyone would save it, or whether it would become the sacrifice that changed everything. The cracks beneath the surface. By late summer 2008, By late summer 2008, the facade was beginning to fracture. From the outside, Lehman Brothers was still standing. Its headquarters still gleamed in Manhattan. Executives still wore tailored suits. Earnings calls still carried confident language. But internally, something had shifted. The numbers no longer reassured. They warned. The liquidity clock. Investment banks do not fail like ordinary companies. They do not slowly wind down operations over years. They collapse when liquidity disappears. And liquidity can disappear in days. Lehman depended heavily on short-term borrowing in the repo market. Each morning, billions of dollars had to be rolled over. Each afternoon, counterparties had to remain confident. This daily renewal of trust functioned like oxygen. Invisible, constant, necessary. By August 2008, that oxygen was thinning. Lenders were demanding more collateral. Haircuts, the percentage discount applied to securities used as collateral, were rising. This meant Lehman had to pledge more assets to borrow the same amount of cash. That created pressure. Pressure required asset sales. Asset sales drove prices lower. Lower prices weakened the balance sheet. Weakened balance sheets scared lenders. The cycle fed itself. This is how liquidity crises form. Not with explosions, but with tightening. The internal emails. After the collapse, investigators reviewed thousands of internal communications. What they found was not ignorance. It was awareness, mixed with hope. Executives discussed liquidity stress. Risk managers flagged concentration in commercial real estate. Some senior leaders acknowledged that market perception had turned decisively negative. But there was disagreement about severity. Some believed the crisis was cyclical. Others feared structural collapse. The firm was divided between two instincts: defend the franchise or preserve capital. And preserving capital would have meant something unthinkable: admitting weakness. On Wall Street, perception is reality. If Lehman publicly announced that it needed emergency capital, markets might interpret that as confirmation of insolvency. So instead, leadership tried to project strength. Even as funding pressures intensified. The real estate problem. Lehman's greatest vulnerability lay in commercial real estate, office towers, condominium developments, large-scale property investments. Unlike publicly traded securities, these assets were difficult to value in volatile markets. When transactions slow, price discovery becomes uncertain. And when price discovery becomes uncertain, lenders assume the worst. By mid-2008, real estate markets were freezing. Potential buyers hesitated. Credit was tightening. Projects stalled. Lehman held tens of billions in these positions. And they were illiquid. Illiquidity is dangerous in leveraged institutions, because you cannot quickly convert it to cash. And without cash, you cannot survive a funding shock. The market turns. In early September 2008, Lehman reported a quarterly loss of nearly $4 billion. It announced plans to spin off troubled real estate holdings into a separate entity. The idea was simple: isolate the toxic assets, restore confidence in the core business. But investors were no longer easily reassured. The market reaction was swift. Lehman's stock fell sharply. Credit default swap spreads surged, signaling rising expectations of default. The stock market was no longer debating profitability. It was questioning survival. And survival in finance is binary. The psychology of collapse. Financial crises are not purely mathematical. They are psychological. Fear spreads faster than facts. Once investors believe an institution might fail, they act defensively. They withdraw funding. They sell shares. They reduce exposure. Each protective move weakens the institution further. This dynamic was now accelerating around Lehman. Hedge funds pulled balances. Money market funds reconsidered exposure. Counterparties shortened lending terms. No single action destroyed Lehman, but collectively they suffocated it. The firm was trapped in a paradox. It needed confidence to survive, but to regain confidence it needed time, and it was running out of time. The search for capital. Behind closed doors, Lehman pursued emergency options. Executives explored raising new equity from investors in Asia and the Middle East. They attempted asset sales. They sought strategic investments. But potential investors demanded transparency. They wanted clarity on real estate valuations. They wanted guarantees against future losses. Lehman could not easily provide either, because the market itself did not know what those assets were worth. When markets freeze, valuation becomes subjective, and subjectivity breeds caution. The regulatory dilemma. At this stage, attention turned to policymakers. Earlier in 2008, Bear Stearns had been rescued with assistance from the Federal Reserve. That intervention had stabilized markets, temporarily. Now officials at the U.S. Department of the Treasury faced a critical decision. Should they intervene again, or should market discipline take its course? The concept of moral hazard weighed heavily. If every institution expected rescue, excessive risk-taking would continue. But if Lehman collapsed, contagion could spread. There was no clear precedent, no playbook, and no guarantee that either decision would prevent disaster. The weekend approaches. By Thursday, September 11, 2008, the situation had become urgent. Lehman stock was collapsing. Rumors swirled through trading floors. Liquidity buffers were shrinking. Emergency meetings were scheduled for the weekend. Executives from major financial institutions were summoned to New York.
Régulateur demandait de solutions.
Potential buyers intensified due diligence. The atmosphere was tense, because everyone understood something fundamental. If Lehman failed, markets might interpret that failure as systemic. And systemic crises do not remain contained. Inside the building, as negotiations unfolded, Lehman employees continued working. Trading desks operated.
Phones rang.
Meetings were held, but uncertainty filled the corridors. Some employees began quietly updating resumes. Others reassured clients. Senior management projected determination. Yet internally, the firm was bracing. For 158 years, Lehman had survived every economic storm. Friday afternoon, the calm before the storm. On Friday, September 12th, Lehman stock had fallen sharply again, signaling deepening investor anxiety. Trading desks were quieter than usual. Phones buzzed nonstop with investors and counterparties seeking reassurance. Executives at Lehman understood the stark reality. They were running out of liquidity. Without new capital, without a buyer, the bank could not survive until Monday. Internal projections estimated only a handful of days before the repo market would no longer roll over financing. Meanwhile, in Washington, Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke were convening emergency meetings. Their mandate was clear: assess the systemic risk and determine whether federal intervention was required. There was a growing debate in the room. Some argued that Lehman was too big to fail, like Bear Stearns months earlier. Others warned that another rescue would intensify public outrage over bailouts, creating political peril. Each option carried enormous risk. Saturday, the negotiations begin. Saturday morning, executives from Lehman, Bank of America, and Barclays gathered in New York for extended negotiations. Lehman's leaders, led by Richard Fuld, presented a case for survival. They laid out balance sheets, risk positions, and potential asset sales. They emphasized profitability projections, hoping to instill confidence in potential acquirers. Bank of America considered a partial acquisition, but the lack of federal guarantees made the deal almost impossible. Barclays, though interested, faced regulatory constraints in the UK. Without government backing, both institutions hesitated. Behind closed doors, tensions mounted. Lawyers, bankers, and federal officials worked around the clock to explore alternatives. The room was filled with urgency, anxiety, and subtle panic. Decisions that would define the global economy were being debated in real time. The moral hazard debate. A key concern dominated the weekend discussions. Moral hazard. Government officials worried that rescuing Lehman would set a dangerous precedent. If Wall Street firms believed that every misstep would be bailed out, risk-taking would intensify. Future collapses could become inevitable. Yet failing to intervene could trigger systemic contagion. Markets relied on confidence, and confidence was already fraying. Money market funds had begun reassessing exposure to investment banks. Hedge funds were selling off positions. International banks were reducing credit lines. In these hours, policymakers faced a philosophical and practical dilemma. Should they prioritize market discipline or systemic stability? There were no perfect choices, only consequences. Sunday morning, the last-minute push. Sunday, September 14th. The final hours before the U.S. markets opened Monday morning. Executives at Lehman scrambled to salvage the situation. They contacted private investors abroad, exploring capital injections. They prepared legal frameworks for potential asset sales. They tried to assess every angle: mergers, partial acquisitions, emergency financing. Meanwhile, federal officials remained cautious. Treasury and Federal Reserve staff evaluated risk exposure, considering the domino effect if Lehman failed. They compared the situation to Bear Stearns, reviewing the pros and cons of intervention. As hours passed, it became increasingly clear. Without explicit government guarantees, neither Bank of America nor Barclays could complete a purchase. Lehman's options were narrowing by the hour. Sunday afternoon, reality sets in. By mid-afternoon, the realization crystallized. Lehman Brothers would not receive a bailout. There would be no public guarantee, no emergency capital injection, no federal lifeline. Executives, once confident, now faced the inescapable truth. Employees were informed to prepare for bankruptcy. Legal teams finalized filing documents. Senior leaders braced for public fallout. The city outside the Lehman building was unaware of the full magnitude. Traders on Wall Street speculated quietly, but the panic had yet to ripple through the markets. Inside, however, every phone call, every email, every conversation reflected the same urgent question. How would the world react on Monday morning? The final hours. In the final hours before filing, Lehman's leadership took steps to manage perception. They held internal meetings to reassure employees. They prepared press statements emphasizing stability. They attempted to contain leaks and prevent chaos. But no amount of preparation could change the facts. The firm's liquidity was exhausted. Repo lines had closed. Counterparties refused to extend credit. Investors had lost confidence. The once mighty institution, with 158 years of history, had reached the limit of what its risk model could withstand. The tools that generated enormous profits during expansion, leverage, short-term borrowing, and complex securities now amplified its collapse. Sunday evening, the decision. By evening, the decision was final. Lehman would file for Chapter 11 bankruptcy. The filing documents were prepared. Legal teams coordinated with the court. Executives finalized communications for employees and clients. At 9 p.m., the final approval was given internally. The announcement would come the following morning. For regulators, policymakers, and market participants, the weekend had clarified the stakes. Failure was now inevitable. The question was no longer if Lehman would collapse, but how badly the global financial system would be affected. The psychological weight. For employees, the weekend was a study in psychological tension. Frontline staff faced uncertainty about their jobs. Traders faced frozen positions. Risk managers realized that the institution they had spent decades building was crumbling. Executives, accustomed to control, faced helplessness. They could analyze data, negotiate terms, and explore solutions, but the market's collective psychology had taken the reins. Confidence, once abundant, had evaporated. Preparing the world for Monday. By late Sunday, steps were taken to communicate with key financial institutions to prevent a broader panic. Clearinghouses, central banks, and major counterparties were alerted. Contingency plans were reviewed. Yet despite preparation, no solution could prevent the shock. Lehman's bankruptcy was imminent. The combination of leveraged positions, complex assets, and short-term funding created a situation where even a single misstep could have catastrophic consequences. Reflection. The weekend of September 13th to 14th, 2008 demonstrated the fragility of the global financial system. It showed how centuries-old institutions, deeply integrated into global markets, could be vulnerable to liquidity shocks. It illustrated the limits of human foresight. Models could predict probabilities, but they could not account for fear. Risk officers could warn, but decisions are influenced by pride, optimism, and competitive pressure. And it exposed the stark reality of moral hazard. When to save a failing institution, and when to let it fail, is a judgment that no single individual can make without consequences. As Sunday night ended, Wall Street braced for the unknown. By Monday morning, the world would witness the largest bankruptcy in U.S. history and feel the first tremors of a global financial earthquake. After the fall, Monday morning, September 15th, 2008, began like any other on Wall Street. Traders arrived early, coffee in hand, briefcases slung over shoulders. Newspapers lined the streets. Digital tickers updated with overnight market movements. But by 9:30 a.m., the financial world would wake up to a shock that would reverberate globally. The announcement. At precisely 9:30 a.m., Lehman Brothers filed for Chapter 11 bankruptcy. The filing listed over $600 billion in assets, the largest bankruptcy in U.S. history. The immediate reaction was disbelief. Analysts scrambled. Investors panicked. Credit default swaps surged. Stock prices fell across all major markets. The Dow Jones Industrial Average dropped sharply. Television screens across the country displayed flashing headlines. Lehman Brothers files for bankruptcy, Wall Street in shock. From Tokyo to London, trading floors went silent as news spread. Lehman's fall was not just an American event. It was a global financial earthquake. The immediate market reaction. As traders absorbed the news, panic rippled through the financial system. Money market funds, which rely on short-term lending, began to reassess exposure to banks. Hedge funds liquidated positions. Counterparties pulled back from lending. The repo market, where Lehman had borrowed billions overnight, froze further. Institutions demanded more collateral or refused to lend. Suddenly, the invisible network of trust that underpins global finance was unraveling. Lehman's collapse had not caused the crisis. It exposed a systemic vulnerability. In London and Frankfurt, stock exchanges reacted similarly. Lehman's bankruptcy was a signal. No institution was too big to fail. For investors worldwide, the rules of the game had changed overnight. The employee perspective. Inside Lehman, the mood was somber. Traders, analysts, and back-office staff watched monitors display plummeting positions. Employees began receiving notices about bankruptcy proceedings. Severance and bonuses were frozen. Many employees who had dedicated decades to the firm suddenly faced unemployment. Some had invested personal savings in company stock through employee stock purchase plans. The psychological impact was immense. Pride, trust, and identity were tied to the firm. In an instant, those anchors were gone. Executives tried to maintain calm. Richard Fuld addressed remaining staff, emphasizing orderly wind-down procedures. But morale was fractured. The collapse felt personal, historical, and final. Contagion across the financial system. Lehman's bankruptcy did not occur in isolation. Banks with exposure to Lehman's assets faced immediate losses. Counterparties across the globe were forced to reassess liquidity. Lending froze. Corporate credit lines tightened. Insurance companies like AIG, heavily exposed to Lehman through credit default swaps, faced existential threats. Without immediate government intervention, AIG's collapse could have triggered another cascade of failures. Other institutions, like Goldman Sachs and Morgan Stanley, scrambled to stabilize their balance sheets, reduce risk, and reassure investors. The world's financial system, interconnected and leveraged, revealed its fragility. Lehman had become the spark in a network of dry kindling. Government response. In Washington, policymakers moved quickly. The Federal Reserve and U.S. Department of the Treasury coordinated to contain panic. Emergency meetings were convened with major banks to ensure liquidity. The goal was to prevent a broader collapse of the financial system. Immediate measures included providing short-term lending to stabilize critical institutions, coordinating with global central banks to ensure currency and credit flow, implementing temporary guarantees for money market funds. Despite these efforts, the psychological shock of Lehman's collapse was profound. Confidence, once assumed, could not be instantly restored. The public reaction. Outside Wall Street, ordinary Americans were beginning to feel the impact. Retirement accounts tied to stock markets declined. Mortgage rates tightened. Credit cards and loans became harder to obtain. Media coverage intensified, framing Lehman as a cautionary tale of greed, mismanagement, and unchecked risk. Headlines painted the narrative. The bank that brought the market down. Public anger began to simmer, particularly regarding executive bonuses, opaque practices, and the seeming impunity of leadership. Many questioned why some institutions, like AIG, would receive rescue while Lehman was allowed to fail. The global impact. Lehman's bankruptcy quickly rippled through international markets. In Europe, banks with exposure to U.S. mortgage-backed securities faced severe losses. In Asia, capital flows slowed, and stock markets plunged. Currency markets reacted. Investors sought safe havens, government bonds, gold, and cash. Volatility surged across equities, commodities, and derivatives. This was the moment when a domestic failure became a global financial crisis. Lehman's fall exposed how interconnected and interdependent the modern financial system had become. Every major financial center now faced the same urgent questions. Who else could fail? How deep would the contagion spread? What could regulators do to contain it? The human cost. The bankruptcy was not only a financial event, it was a human one. Employees lost their jobs. Families faced uncertainty. Retirement savings vanished. Businesses reliant on credit struggled to operate. Even in the short term, the psychological toll was staggering. Fear of systemic collapse led to frozen lending, delayed business investments, and job insecurity. Lehman's failure was both a signal and a symptom. A signal that markets could collapse without warning, and a symptom of underlying systemic weaknesses in leverage, liquidity, and risk management. The aftermath of the day. By the end of Monday, September 15th, the world had changed. Lehman was gone. Markets had absorbed the shock. But the work to stabilize the system had only begun. Banks scrambled to shore up liquidity. Regulators increased coordination. Governments prepared for potential rescues of other institutions. For the global economy, it was the first domino to fall. And as subsequent weeks would show, this single bankruptcy would trigger a chain reaction affecting institutions, governments, and citizens worldwide.
Trésorerie intervention.
Treasury Secretary Henry Paulson played a central role in coordinating the response. Recognizing that Lehman's failure had created panic, but that systemic collapse was still preventable, the Treasury sought to reassure markets. Public statements emphasized that other major institutions were sound, that liquidity lines were being maintained, and that emergency funding was available. This communication, though subtle, helped prevent a complete collapse of confidence. Psychological stability was as important as financial stability, a lesson Wall Street would never forget. The AIG rescue. Just days after Lehman fell, the government made a starkly contrasting decision. Rescuing AIG. AIG was heavily exposed to credit default swaps on mortgage-backed securities, including Lehman's assets. If AIG had failed, the domino effect could have destabilized dozens of major banks worldwide. The Federal Reserve and Treasury arranged a $85 billion emergency loan, effectively saving AIG from collapse. While controversial, this intervention underscored the principle of systemic importance. Some institutions, due to their interconnectedness, could not be allowed to fail. This dichotomy, Lehman let go, AIG saved, sparked intense debate. Critics questioned the rationale, calling it inconsistent and politically motivated. Supporters argued it was a necessary decision to prevent a chain reaction of failures. Regardless, the lesson was clear. The financial system could survive massive shocks, but only through extraordinary government intervention. Global coordination. The crisis was not confined to the U.S. Central banks around the world responded with coordinated measures. The Bank of England, the European Central Bank, the Bank of Japan, and others injected liquidity into their respective markets. Currency swaps were arranged to ensure that dollar funding was available globally. This international coordination prevented a worldwide freeze of credit markets. The collapse of Lehman could have triggered simultaneous panics across all major financial hubs. Instead, central banks acted as stabilizing anchors.
Surviving institution.
Some banks weathered the storm better than others. Goldman Sachs and Morgan Stanley converted to bank holding company status, gaining access to Fed emergency funding. Their decision allowed them to secure liquidity lines that non-bank holding companies lacked. Other firms, like JP Morgan and Citigroup, engaged in opportunistic acquisitions of distressed assets at discounted prices. These moves strengthened their market position and helped absorb some of the systemic shock. Market psychology. Survival was not solely due to capital injections or acquisitions. Psychology played a massive role. Markets are governed not just by assets and liabilities, but by perception. Investors needed reassurance. Once confidence stabilized, lending resumed, markets found buyers, and panic began to subside. Government communication, media messaging, and market behavior all contributed to restoring a sense of order. This intangible element, confidence, was as critical as tangible liquidity. Regulatory lessons. Lehman's collapse exposed significant flaws in oversight and risk management. Regulators quickly identified gaps. 1. Capital requirements. Existing regulations had not accounted for the extreme leverage in investment banks. 2. Liquidity risk. Firms could fail not because of insolvent assets, but because short-term funding evaporated. 3. Interconnectedness. The global banking system was more interlinked than regulators realized. 4. Shadow banking. Non-bank financial institutions operated with minimal supervision, contributing to systemic risk. These lessons would later inform major reforms, including the Dodd-Frank Act, stress testing regimes, and enhanced oversight of derivatives markets. The narrow escape. By the end of September 2008, the system had survived, but narrowly. Lehman's bankruptcy alone could have cascaded into a total collapse. The government's rapid intervention with AIG, combined with global central bank coordination and surviving institutions' actions, prevented the worst-case scenario. However, the financial system remained fragile. Confidence could still evaporate, and liquidity gaps could still occur. This fragility would define the next several months of the financial crisis, including further bank rescues and the eventual stimulus programs. Human stories of survival. While the focus often rests on institutions, human stories illuminate the true impact. Bank employees who survived faced job insecurity, relocations, and a new culture of risk aversion. Investors who relied on short-term credit or retirement accounts saw sudden losses. Yet there were also stories of resilience. Firms that adapted survived. Investors who diversified weathered the storm. Policymakers learned valuable lessons about crisis management. The survival of the system was a combination of human decision-making, regulatory action, and sheer luck. Reflection. The system that survived after Lehman's fall was a fragile, temporary stabilization. It demonstrated that liquidity is king. Without it, even venerable institutions collapse. Confidence drives markets. Perception can matter as much as reality. Intervention can prevent catastrophe. Government action, though controversial, can stabilize critical points. Lessons must be learned. Systemic risk, leverage, and interconnectedness require oversight. The collapse of Lehman was a lesson written in real time. The system could survive, but only if institutions, regulators, and governments acted decisively, and sometimes unpredictably. Did they know? One of the most compelling questions about Lehman Brothers is deceptively simple. Did they know? Did executives, traders, and risk managers understand the danger before the collapse? Or was it a complete surprise? A sudden failure in a system that had seemed stable? The answer, like the collapse itself, lies somewhere between denial, optimism, and deliberate strategy. Early warnings ignored. In the months leading up to September 2008, multiple internal signals indicated mounting risk. Risk management teams flagged concentrations in subprime mortgage-backed securities. Liquidity analysts warned that repo lines were tightening. Treasury groups projected worst-case scenarios showing the firm could run out of cash within weeks under adverse conditions. These warnings were documented in emails, memos, and presentations. One internal note explicitly warned, "Liquidity risk is growing. Leverage may amplify losses if markets deteriorate." 3. Transparency matters. Perception management may delay panic but cannot prevent systemic failure. 4. Cognitive biases influence even experienced executives. Overconfidence, short-term focus, and moral rationalization played a key role. Lehman's collapse was not a simple failure of information. It was a complex interplay of knowledge, psychology, culture, and external market forces. Reflection. By the end, it becomes clear that Lehman's leadership did not operate in ignorance. They had access to data, analyses, and warnings. They understood the stakes. But their choices, influenced by culture, incentives, and human bias, allowed risk to accumulate unchecked. The collapse was, in many ways, predictable. And yet, predictable does not mean preventable, especially in a system dominated by leverage, complexity, and perception. Lehman Brothers became a cautionary tale, a reminder that knowing the danger is not enough. Acting decisively, ethically, and timely is what separates survival from catastrophe. The warning for the future. The collapse of Lehman Brothers was more than a historical event. It was a warning, not just for Wall Street, but for regulators, governments, investors, and society at large. The lessons it left behind would reshape financial systems, influence policy for decades, and alter the collective understanding of risk, human behavior, and the fragility of global markets. Systemic vulnerabilities exposed. Lehman's failure revealed deep systemic vulnerabilities that had been growing for years. 1. Excessive leverage. Investment banks had grown comfortable borrowing 30, 40, or even 50 times their equity. This amplified profits in good times but also amplified losses. Small shocks could wipe out entire firms. 2. Short-term funding reliance. Banks depended heavily on overnight financing. Liquidity evaporates instantly if confidence falters, creating rapid collapses. 3. Opaque assets. Complex securities like mortgage-backed securities and collateralized debt obligations were difficult to value, even internally. Uncertainty bred fear in counterparties and investors. 4. Interconnectedness. Global banking was tightly linked. One failure could trigger cascading defaults across continents. These factors formed a perfect storm. Lehman was the spark, but the storm had been brewing for years. Regulatory reforms post-crisis. In the wake of the collapse, regulators moved aggressively to prevent a recurrence. The Dodd-Frank Act imposed stricter capital requirements and liquidity rules for large banks. The Federal Reserve established stress tests to evaluate how institutions would survive extreme scenarios. Greater oversight was applied to derivatives and shadow banking activities, previously operating with minimal regulation. Too big to fail institutions were forced to create living wills, detailing how they could wind down in bankruptcy without threatening the system. These reforms aim to reduce leverage, increase transparency, and provide tools to manage liquidity shocks. Cultural shifts in finance. Beyond regulation, Lehman's collapse prompted a reevaluation of Wall Street culture. Risk awareness became more prominent. Boards and executives emphasized scenario planning and extreme stress testing. Incentive structures were scrutinized, particularly bonuses tied to short-term profits. Misaligned incentives had encouraged excessive risk-taking prior to 2008. Transparency and communication were recognized as critical. Investors, regulators, and employees needed accurate information to maintain confidence. The crisis forced the financial sector to balance profit-seeking with prudence, at least temporarily. Lessons for investors and individuals. Lehman's story also offers lessons beyond the boardroom. 1. Diversification matters. Concentration in high-risk assets can be devastating. 2. Liquidity risk exists everywhere. Even well-capitalized investments can be affected if markets freeze. 3. Confidence is fragile. Perception can trigger real consequences faster than fundamentals. 4. Critical thinking is essential. Blind trust in institutions, models, or historical trends can be dangerous. The human element, judgment, fear, and bias, plays as significant a role as spreadsheets and balance sheets. The psychological legacy. The collapse revealed that human psychology shapes markets as much as economics. Fear spreads rapidly. Optimism can blind decision-makers. Cognitive biases, overconfidence, groupthink, and moral disengagement influence strategy and can amplify systemic risk. Lehman's executives had information. They had warnings. They had models. Yet the interplay of culture, incentives, and human psychology allowed a preventable collapse to occur. The lesson: systems fail not just because of numbers, but because of people. Global implications. The shockwaves of Lehman's bankruptcy affected global finance. Stock markets plunged worldwide. Credit markets froze, affecting businesses and consumers. Governments intervened with stimulus programs, bailouts, and coordinated monetary policy. International financial systems implemented new safeguards to prevent contagion. Lehman became a symbol of interconnectedness and vulnerability in a modern, globalized economy. Enduring lessons. 1. Transparency saves lives. Clear, accurate reporting reduces panic and stabilizes markets. 2. Liquidity is vital. Even profitable institutions can fail without sufficient short-term funding. 3. Human judgment cannot be ignored. Risk models are tools, not replacements for ethical and strategic oversight. 4. Moral hazard must be managed. Rescues can stabilize markets but may encourage future recklessness if unchecked. 5. Preparedness matters. Contingency planning, stress tests, and living wills are not optional, they are essential. These lessons extend beyond banks. Any system, economic, corporate, or social, requires awareness of vulnerabilities, clarity in communication, and contingency planning for rare but catastrophic events. Conclusion. Lehman Brothers' collapse was a historic moment, the largest bankruptcy in U.S. history. It was the product of high leverage, reliance on short-term funding, opaque assets, and human decision-making under pressure. It exposed weaknesses in regulation, oversight, and incentive structures. Yet, the global financial system survived. Emergency interventions, international coordination, and decisive actions by surviving institutions prevented a total collapse. The ultimate lesson is clear. Risk is inevitable, failure is possible, and the cost of ignoring warning signs is immense. Lehman's story is a warning, a case study, and a mirror. It reminds us that in finance, as in life, knowledge without action is incomplete. Confidence is as fragile as it is powerful. And human decisions made under pressure and colored by bias can shape the fate of the world. The collapse of Lehman Brothers is no longer just a historical event. It is a lesson etched into the architecture of global finance, a reminder that the dark history of risk, greed, and human error continues to cast long shadows.